There's a tax that the people who did everything right are most likely to pay. It's not the people who gambled or inherited a lot of assets. It's the disciplined savers, the people who maxed out their 401k throughout their entire career, and they're the ones that are walking straight into a tax situation that most advisors either don't fully understand or have never explained until it's too late. And the IRS has been collecting this tax for decades. Hi, I'm Wes and founder of Vault Private Wealth. This is the kind of thing that I think about constantly because once you see it, you can't unsee it. The people who need to know this are the ones who are still in the window where there's something that can actually be done about it. So here's what we're going to get to by the end of this video. I'm going to show you the specific years, the exact window where you can dramatically reduce this problem, what those years are actually worth in real dollars, and why most people waste them completely. But first, we need to understand how all of this comes together because this isn't just some abstract tax theory. It's the very specific intersection between three parts of the tax codes, parts that were written at very different times by very different Congresses for very different reasons, and they happen to collide right around the time that you retire. So the first piece, Congress decided in 1983 that Social Security benefits should be partially taxable for people with higher incomes. And that's fine, it totally makes sense. They needed to shore up the funds in the trust. They set some income thresholds and they said that if your provisional income, which is basically your adjusted income and half your Social Security, exceeded $32,000 as a married couple, up to 50% of your benefit gets taxed. If it crosses $44,000, up to 85% of your benefits become taxable. And here's the part that I want you to sit with for a second. Those thresholds, $32,000 and $44,000, they were set in 1993. They haven't been adjusted for inflation, not even once, for over 30 years. In 1993, $44,000 was a pretty good household income. The median household income that year was about $32,000. So these thresholds were designed to only capture high earners. But today, a couple collecting an average Social Security benefit, not even a large one, just an average one, plus let's say about $50,000 in IRA withdrawals, is already in the 85% zone. And that number never changed despite the fact that the world around it has inflated significantly. And because of that, the share of Social Security beneficiaries who are paying more income taxes than their benefits has gone from 8% when the rule was first created to nearly 50% today. And it still climbs every year as inflation increases, but these thresholds stay the same. So that's the first layer, but now let's add a second one. The second layer is your required minimum distribution, or RMD. And here's how it works. Right now, under the current law, the IRS requires that you start withdrawing money from your traditional IRA or 401k at age 73. In 2033, that moves to 75 for people who were born in 1960 or later. But regardless of when it starts, they are called required minimum distributions for a reason. Once you hit that range, you no longer get to decide how much of it to take out. The IRS's uniform tax table decides for you. At 73, that first distribution factor is 26.5. That means 1/26.5 of your total traditional balance is going to be withdrawn mandatory from your account. That means if your IRA is worth $1 million, you're forced to withdraw about $37,700. If it's $1.5 million, you're pulling out roughly $56,600. And that's whether you need it or not. This is a required distribution. Now, here's the real problem. Most people who retire at age 65 or even 62, especially the disciplined savers, they aren't spending their IRA down aggressively in their 60s. Like, why would they? The account is still invested, they have other income, and so it just continues to grow. So let me give you an actual scenario here. Let's say a couple retires at 63 and they have $1.5 million in the traditional 401k. They have some Social Security coming at 67, and they're taking modest withdrawals, maybe $40,000 a year. They're not being reckless, and they're being very responsible. So by 73, at a reasonable 6% return, that $1.5 million has grown to about $2 million, even with those withdrawals. Now the IRS distribution factor at 73 on $2 million works out to be about $75,000 of required income. Then add on top of that the claimed Social Security, so let's say that's $55,000 combined. Their provisional income is now over $100,000, and 85% of that $55,000 Social Security check is taxable income. And their tax rate in their early 60s, they were controlling it. They had all this wealth, but they got to decide when they wanted to make the withdrawals and what they would be paying taxes on. But then when they hit 73, they had to take out $75,000 of mandatory taxable income that they didn't even need, and that stacked on top of Social Security and stacks on top of anything else that they have. So the IRS essentially just handed them a paycheck that they didn't want and a tax bill that matched it. And here's what the RMD distribution table also shows. The factor gets smaller every year, which means the percentage that you're required to withdraw gets larger. So by 85, the factor drops to 16, or 1/16 of your total portfolio now being forced to be withdrawn. And that's 6% of whatever you have left. If the account keeps growing, which they often do, the RMDs of your 80s dwarf the ones from your 70s. And the problem compounds every single year. So this is where the two layers combine, and this is the part that's called the tax torpedo, and its name is definitely earned. When you pull $1 from your traditional IRA, that's $1 of taxable income, which is totally normal and exactly how you would expect it to work. But if your provisional income is still in that phase-in zone between $32,000 and $44,000 for joint filers, that extra dollar is also dragging more of your Social Security into taxability. Specifically, for every dollar of extra income in that upper part of the zone, 85 cents or more of your Social Security gets taxed. If you're withdrawing $1, the tax code sees that as $1.85. Apply the 22% tax bracket to $1.85, and you're paying about 40.7 cents of tax on that $1 that you pulled out. That's a 40.7% effective marginal tax rate in a 22% bracket. And this is why people are so surprised when they see how it works, and they realize that they're paying a larger effective tax rate in retirement than they ever did while they were working. It's not because the bracket's higher, but it's because the dollar hits two places at the same time. Now, and this part is counterintuitive, the tax torpedo doesn't hit everyone equally. Most people assume that this is a rich person problem, and ironically, it's not. The high-income retirees with huge pensions, maybe they have a large retirement account already, or six-figure Social Securities, they're already so far past these thresholds that 85% of their Social Security is already taxable, the entire thing. There's no more phase-in left to trigger. The marginal rate is whatever their bracket puts them in. They've already skipped right over this torpedo zone. The torpedo lands hardest on the person who retired with $1 to $2 million in traditional accounts. These people have income that's high enough to get hit, but not enough to clear the phase-in. Their Social Security is still in the zone where every extra dollar of IRA withdrawals drags it more into a taxable bracket. They did everything right. The tax code specifically structured, almost accidentally, to penalize the path that they were told to take. Now, whether this impacts your situation exactly depends on a lot of moving parts. You have your state taxes, your pension income, your Social Security benefits, what accounts your assets are actually sitting in. That's the kind of thing worth actually modeling with someone who knows your full financial picture. But understanding the mechanism, that's on you. And most people don't understand it until the RMDs have already started. And then there's Medicare. This is the part that catches people completely off guard. It's called IRMAA, or the Income-Related Monthly Adjustment Amount. Medicare Part B and Part D premiums are already baked into retirement budgets. Standard Part B in 2026 is $202.90 per month, which is totally fine, and most people plan for that. But if your modified adjusted gross income exceeds $218,000 for a married couple, a surcharge kicks in. And here's the part that catches a lot of people off guard. It's a cliff, not a slope, a cliff. That means that $1 over $218,000 of income doesn't cost you a little bit more. It costs each Medicare enrolled spouse significantly more. The first tier alone adds $81.20 per person per month. For a married couple, that's almost $2,000 a year in additional Medicare costs just from being $1 over the line. And that IRMAA determination is based on your income from 2 years ago. So if you retire and you do a large Roth conversion in year one, maybe more than you should have, and you cross the threshold, you won't see the Medicare surcharge until 2 years later, after you filed and after the damage is done. By the time you notice, it's already too late to fix. The practical implication is that large unplanned RMDs in your 70s don't just create a federal income tax problem. They create a Medicare problem on top of it. In a year where your RMDs are already high, there's a real possibility that you're not just paying more to the IRS, you're also paying more for health insurance too. So, Social Security thresholds that haven't moved since 1993, RMDs that you can't control once they start, a tax torpedo that hits people who save the most diligently, and Medicare surcharges with cliff triggers, all of it is converging to the same age. But here's the thing, and this is the part that I actually think is most important and where I want to spend the last stretch of this video. None of this is irreversible if you're in the window right now. Here's what we call the gap years. The years between you retire and when your RMDs begin, and for people born in 1960 or later, that window is potentially 12 years because RMDs don't start until 75. During those years, something unusual happens to your taxable income. Your paychecks stop, you haven't claimed Social Security yet, or maybe you just started and it's still not the full benefit. And RMDs haven't begun. Your taxable income can be extremely low. For some people, the lowest it's been since their 20s. Which is wild, right? Because this is when you're sitting on the most wealth that you've ever had. But income and wealth are different things. In the gap years, your income is low, and the income is what the tax code actually taxes. That window is where Roth conversions become incredibly powerful. You're moving money from your traditional IRA, where every dollar will eventually be forced out as ordinary income, into a Roth, where withdrawals are tax-free and there are no RMDs ever during your lifetime. You're paying taxes at a rate that you can control rather than the IRS deciding it later. And the math on what this actually does to your situation is very significant. So let's go back to that couple. $1.5 million at retirement with no conversions, that grows to about $2 million by age 73, and their first RMD is about $75,000. Stack that on top of Social Security and they're solidly in the torpedo zone, potentially well over $100,000 in income in their first forced distribution year, with 85% of Social Security now taxable. Now let's run the alternative. They spend the years between 63 and 73 doing moderate Roth conversions. Nothing enormous, but not aggressive either. Maybe $80,000 to $100,000 a year, and they do it carefully so that they can stay below the IRMAA thresholds and fill their bracket efficiently. Over 10 years, they've moved a substantial portion of their traditional IRA into a Roth. That remaining traditional balance is meaningfully smaller. The RMD on a $1 million balance at 73 is about $37,700, not $75,600. That's nearly $19,000 in less mandatory taxable income just from 1 year alone. But here's the thing about the window. It closes. The day your RMDs start, your bracket starts being set by the IRS, not by you. Every year you don't convert in the gap year is a bracket space you've permanently lost. You can't go back and convert at 65 once you're 75. That opportunity is completely gone. So here's a summary of everything we just reviewed, and let's bring it all together. The Social Security provisional income thresholds were set by Congress in 1993. They've never been adjusted for inflation. They were designed, according to the legislative history, to eventually become meaningless because inflation would drag everyone into them over time. They're working exactly as the original drafters intended, and the problem is no one's told you about it. RMDs at 73 and eventually 75 create forced income that you can't avoid. You can't defer it, and you can't control once they start. If your accounts grow between now and then, which they likely will, the mandatory distributions will grow right along with it. The torpedo hits you when those RMDs collide with the Social Security thresholds, creating an effective marginal rate of 40.7% or higher in a bracket where you thought you were maybe paying 22%. And IRMAA turns that income spike into a Medicare surcharge with a $1 cliff and a 2-year look-back window that makes it nearly impossible to fix after the fact. But the gap years, whether that's 5 or 12 years, depending on when you retire and when you start collecting RMDs, those are some of the most valuable tax planning windows that you'll ever have. Now, if you're in or approaching those gap years and you want to actually sit down and model this out for your specific situation to see what your RMDs might look like, what that conversion sweet spot is, whether the IRMAA surcharges are a real risk for you, that's exactly the kind of work that we do at Vault Private Wealth. And you can schedule a complimentary consultation using the link in the description. And if any of this gave you something that you didn't know before, hit that like and subscribe button. This channel is specifically built for people who have done the saving and now they want to make sure that they actually get to keep it. I'll see you in the next one.